Whether you have $10,000 or $10 million to invest, this video is for you. Did you know that Warren Buffett, one of the richest people in the world, made his first stock purchase for less than $120? At the age of 11, he bought 3 shares of a company called City Services Preferred for around $38 per share. From these humble beginnings, Buffett has grown his wealth to over $100 billion and now leads a company valued at over $1 trillion. Now, real quick, if you are new here and would like more investing, money, and finance videos, make sure to hit that subscribe button, notification bell, and like button so you never miss a new video from us. Let's let Warren break it down now.
But how can I make $30 billion?
Start young. Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old. I would do it exactly the same way if I were doing it in the investment world. I mean, if I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena. And as Charlie has said earlier, it won't be like doing that in 1951 when you could leaf through and find all kinds of things that just leapt off the page at you. But that's the only way to do it. I mean, you have to buy businesses or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about. And you can't expect anybody else to do it for you. I mean, people will not tell you about wonderful little investments. It's not the way the investment business is set up. When I first visited Geico in January of 1951, and that rest of that year, I subsequently went down to Blythe and Company, and actually to one other firm that was a leading Geyer and Company.
So very interesting. Starting early is key to building wealth. Think of it like a snowball rolling down a long hill. At first, it's small and slow, but as it rolls, it gathers more snow and picks up speed. Similarly, when you start investing early, your money has more time to grow. This growth happens exponentially over time due to compound interest. Compound interest is a key concept for growing your wealth. It works by earning interest not only on your initial investment, but also on the interest that accumulates over time. This compounding effect can significantly accelerate your financial growth. Warren Buffett's journey to becoming a billionaire is a testament to the power of compound interest. Remarkably, he accumulated 99% of his net worth after his 50th birthday. This shows how long-term investing and compound interest can lead to extraordinary financial growth. In his early career, Warren Buffett learned the fundamentals of investing from his mentor, Benjamin Graham, in New York. Graham's principles of value investing laid the foundation for Buffett's approach to investing. Under Graham's guidance, Warren Buffett focused on buying undervalued companies with strong fundamentals, a strategy that has served him well throughout his career. Warren Buffett's early investments, compounded over decades, set the stage for his later success. For instance, when Buffett started investing in the 1950s, he was relatively young and had modest resources. His disciplined approach, combined with the compounding effect of his investments, allowed him to build substantial wealth over time. As Warren Buffett moved into his 80s and 90s, his success continued to grow. His company, Berkshire Hathaway, became one of the largest and most successful in the world. The value of his investments compounded over the years, contributing to his immense wealth. Buffett's ability to reinvest profits and maintain a long-term perspective demonstrated the powerful effects of compound interest. Warren Buffett's experience highlights how compound interest works best with patience and a long-term investment strategy. His journey shows that even after achieving significant wealth, continuing to invest wisely and allow compounding to work its magic can lead to further substantial gains. Warren Buffett's net worth growth over the years vividly demonstrates the impact of compound interest. To understand this better, let's look at specific points in his financial journey. At age 56, Warren Buffett's net worth was approximately $1.4 billion. By age 59, it had grown to $3.8 billion. This represents an increase of $2.4 billion in just 3 years. This dramatic rise highlights how compounding returns can significantly accelerate wealth accumulation over relatively short periods. Fast forward to Warren Buffett's later years. From age 83 to 91, his net worth soared by over $30 billion, averaging nearly $4 billion in annual growth. The key takeaway is that Warren Buffett's net worth growth isn't linear, but exponential. As his investments continued to compound, the rate of growth accelerated, showing how compound interest can dramatically boost wealth over time. Today, at age 94, Warren Buffett's net worth stands at around $146 billion. In just the past 3 years, his net worth has increased by a substantial amount, driven by the compounding effect of his investments. Let's run through some examples of how this can work in your life. Suppose Nick, at age 25, invests $10,000 and lets it grow for 40 years with a 10% annual return. By the time he's 65, his investment would have grown to approximately $452,590.28. In contrast, Alex starts investing at age 35 with a $25,000 investment, which is $15,000 more than Nick's initial amount. Over 30 years, Alex's $25,000 investment grows to about $436,235.06 at the same 10% annual return. Now, if Alex had started investing 10 years earlier, at age 25, with the same $25,000 investment and a 10% return, his portfolio would have grown to approximately $1,131,481.39 by age 65. Let's now consider different annual returns. With a 12% return, Nick's $10,000 investment grows to around $930,509.70 after 40 years, and to approximately $2,890,021.90 after 50 years. For Alex, the same 12% return grows his $25,000 investment to about $748,998.05 after 30 years, and to roughly $2,326,274.26 after 40 years. At a 15% return, Nick's investment grows to about $2,678,635.46 after 40 years, and to roughly $10,836,574.42 after 50 years. Alex's $25,000 investment grows to approximately $1,655,294.30 after 30 years, and nearly $6,696,588.66 after 40 years. This comparison highlights the powerful impact of both starting early and the compounding effect over time, with Nick and Alex taking their money out at age 65. We can see the significant difference and advantages of getting in early. If you're starting today with $10,000, consider focusing on smaller, overlooked companies. These companies often offer better opportunities for small investors. For example, if you systematically review companies, starting with those listed alphabetically, you might find undervalued businesses with strong fundamentals. Warren Buffett's advice is straightforward but powerful: buy good businesses or stocks at attractive prices. This timeless strategy focuses on investing in companies with solid fundamentals that are currently undervalued by the market. This approach remains relevant today and will continue to be effective in the future. For example, let's say you're considering investing in a company that produces high-quality electric vehicles but is currently undervalued due to temporary production delays. If the company's long-term prospects are strong and it has a solid business model, buying shares at a lower price could provide significant future returns when the market recognizes its true value. Now, to maximize returns based on Warren Buffett's advice, consider Warren Buffett's investment approach. This approach has demonstrated the potential to achieve high returns, even with smaller amounts of money. While achieving 50% annual returns is exceptionally rare and challenging, his success highlights the power of strategic investing and disciplined decision-making. By carefully selecting undervalued stocks with strong fundamentals, even modest investments can grow significantly over time. Combining high-quality investments with the advantage of time allows you to maximize both returns and wealth accumulation. Smaller companies often receive less attention from investors and analysts compared to larger, more established firms. This lack of focus can lead to these smaller companies being undervalued, presenting opportunities for savvy investors. Investing in these overlooked companies can offer significant growth potential if they possess strong fundamentals and show promise for future success. To illustrate, consider the comparison to buying a house. When there's high competition in the housing market, prices tend to rise as many buyers bid for the same properties. In contrast, when competition is low, there are more opportunities to find undervalued properties at a better price. Similarly, smaller companies in less popular sectors can offer better investment opportunities at lower prices compared to their more prominent counterparts. By investing in these less noticed, undervalued companies, you can potentially achieve higher returns as they grow and gain more recognition. To find promising smaller companies, you can use a stock screener to filter potential investments based on key financial metrics. Start by searching for companies with market capitalizations between $50 million and $500 million. This range helps target smaller companies that may be undervalued compared to their larger counterparts. Further refine your search by examining companies with low price-to-earnings ratios. A lower price-to-earnings ratio can indicate that a company is undervalued relative to its earnings, making it a potentially attractive investment opportunity. By using these filters, you can identify smaller companies that are not only less recognized but also have the potential for substantial growth, offering the possibility of significant returns on your investment. Warren Buffett's investment philosophy also emphasizes trusting your own research rather than relying on others. This principle is well illustrated by his experience with Geico in 1951. Buffett discovered Geico through his own research and saw its potential long before it became widely recognized. Despite his enthusiasm, leading investment firms dismissed Geico as a small, unremarkable company. Buffett's decision to trust his own analysis and invest in Geico proved to be highly rewarding. Over time, Geico became a major success, and Buffett's investment paid off handsomely. Another example is Warren Buffett's investment in Apple. While many investors were skeptical about Apple's ability to innovate and maintain its market position, he did research and understood the company's fundamentals, which led him to invest. His belief in Apple's strong business model and its potential for future growth resulted in significant gains as the stock price appreciated. In conclusion, harnessing the power of compound interest and focusing on smaller, undervalued companies can significantly enhance your investment returns. By understanding how compound interest works and investing in companies with growth potential, you position yourself for long-term financial success. If you found this video helpful, please like and subscribe to our channel for more videos on investment strategies. Our goal is to help you become a better investor by sharing successful approaches and proven tactics. Thank you for watching, and see you in the next one.